beverages. Cheers. Thanks for coming out this morning.
Yeah, thanks for the coffee.
Hanging with me. And Tyler on this beautiful Saturday morning. So Barbara, you're like the local leading lender. That's what I've been like dubbing you as on my social media.
Okay.
Like all my have you seen like my story posts and everything?
Yes.
I keep calling you that. Do you like that title?
It's awesome.
Is that fair?
Yes.
Okay, cool. So how are things going this year for you guys at Movement?
Things are definitely very interesting. So, it's playing a lot with the market, just trying to adjust every month. It's not like it's been the same, for 6 months in a row. Like every month it's different. So, yeah.
Is it like, do you feel kind of like a stockbroker or something? You wake up every morning and check your numbers and
pretty much
make sure everything's still happening? Yeah.
Yep. Pretty much. I get text alerts, so I'm signed up to kind of find out what's going on with the market. So I know what's going on with interest rates. So, if I have buyers that are waiting to lock in a loan, I, kind of pay attention to what's going on all my different updates that I'm getting. So we get these, it's funny because we get these phone calls and we all get them. And, it'll be, if we're all in a room with a bunch of loan officers and you all of a sudden see everybody look at their phone and look up, it means we got an alert to lock.
Yeah.
Which means, rates are going to change. So if you have anybody that was waiting to lock a loan, you need to hurry up and get into their loan and get it locked.
How often is that happening?
Okay, so that's the fun part about what's been going on the last couple of years, or last couple of months, sorry. It doesn't happen all the time, but sometimes when the Fed starts raising, the Fed funds rates and stuff, when those start going up, you'll start to see an adjustment. If you see the market, things are going on in the market, you'll start to see those notifications come out. Sometimes we get them like twice a day, maybe 3 times a day, sometimes like for a couple days in a row. So right now it's been holding steady. We haven't really gotten a lot of those alert to locks.
So as of today, and we're like, today's like the Saturday, the 22nd. Where are we floating right now on rates?
Rate-wise, well, it depends on the type of loan. But for the most part, I'd say we're in probably like 5.5 to 6 in that price range. And now that's for a conventional purchase, like a single-family home, primary residence. Okay. So the difference is there's a lot of different interest rates based on what you're purchasing.
What was that average a year ago?
A year ago, probably in the 3s.
Yeah.
Yeah, so if you came to me last year to qualify for a loan, I was quoting you in the 3s, low 3s. And then starting probably around January, February, March-ish is when the rates kind of started like going up quickly. So if I quoted you in December, you were probably in the 3s. If we went back to look at your loan again by March, you were in the 5s.
Wow.
So almost a 2-point difference.
Wow.
And it's so sad. I feel terrible, telling my borrowers, if they didn't find a home back then, when they were in the 3s, now they're in the 5s. So kind of.
So something I posted about this last year was like, here's what a house costs now. If it's a $400,000 house and you get it at 3%, and everyone's been, all the social media experts. It's like anything. If something happens in the news, all of a sudden everyone's like an expert on.
In it,
everyone became an expert in medicine over the last year. Everyone's become an expert in foreign policy over the last year. And now in our little world, big world, everyone. I hear a lot of the, well, when's the crash coming? Then I should buy. And we've dealt with clients and like, look, even if this house goes down to 350 and you're paying between 5 and 6% over the course of the loan, you're gonna end up paying more for that house. And the problem we're seeing in Central Florida, or what I think people are realizing, hindsight, if they weren't listening to those posts for me, they're going, well, interest rates are going up and the prices really aren't going down. And I tell everyone, like, it's simple supply and demand. Like, there's still huge demand from the buyer side. We may not necessarily be seeing 24 offers in 24 hours, but we're still selling houses and getting them under contract in a week or two, which even 3-4 years ago was great.
Yeah.
So the market's still good if you're a seller. It's great, but these interest rates, What do you guys think? What are you hearing? What are you feeling like by the end of the year? Do you think those interest rates are going to come down, or are they going to continue to rise? For those people, if you had to talk to them that are like, should we wait for a crash? Like, I like to just shut that down right away. It's like the market, especially in Central Florida, we're not heading towards a crash, at least a housing market crash. It's not any of the same variables that we were facing in 2007, 2008.
No.
Like, that is not on the horizon. Things aren't necessarily hockey sticking price side. That's what I look at a lot. We are leveling out a little bit, I feel like, which is good. I feel like it's healthy for the market to breathe a little bit. And I think a lot of that is because interest rates are rising. We are seeing a little bit slower response to putting something on the market. But again, it's slowing down from like a house being pending in hours to days, which is still great. No one's getting under market value for homes.
Right.
You know, people aren't foreclosing on houses, stuff like that. But in terms of the rates, what they've been going up, been getting those alerts. What do you think maybe the next 6 months are going to look like for people? Or if somebody is looking to buy today, is it still a good option to buy today and consider maybe a refinance in a year or so? Or, you know, if I was looking to buy today and I had that question, how, like, what should I do?
Yeah. Well, I do get that question a lot. I have people asking me, you know, what should I do? Should I buy now? You know, and I'm like, well, yeah, you know, I can't absolutely tell you, and I don't have that crystal ball that we always talk about. But so I have some good news and some bad news, right? So it depends on where you're at with these things. We do have a market analyst that we are advised by, you know, kind of quarterly, and we just had a Zoom call with him the other day. So what he's kind of predicting is that there will be a recession towards the end of the year, right? So which could be good, could be bad. Again, like I said, depends on where you're at on that thinking. But with every recession, we've always seen interest rates go back down. So could be a good thing. So I keep telling people kind of maybe like hang tight for right now. If you can kind of wait till the end, like maybe more towards September, October, that might be more of the sweet spot where you'll see the rates start to come back down. Now the Fed funds could raise their rate again, but the one thing that people don't understand is that that's not the interest rate, right? That's the Fed funds rate. That's not how we operate. Yes, we'll see some adjustment from it, but that doesn't mean interest rates are going up if they raise those rates. So the one thing that I would like to share is that one of my clients, you know, because right now we're all thinking, well, if we all buy now, we can always refinance down the road, right? I don't foresee us getting back down into the 2s and 3s necessarily, right? Because that was like pretty nice what we had.
Yeah.
But if you're in the 5s and 6s right now, we could see the 4s is what we're hearing. So you could bring it back down into a 4, you could refinance. But one of my clients is buying an investment property right now. And we looked at interest rates and he's like, well, why don't I pay some points to bring that rate down now and just get the better rate now instead of, you know, refinancing and having those closing costs all over again next year. Right?
So yeah, like investment, I think, is this a client is this one of our clients?
Yes.
Or we have an investment client that's
Yes.
a similar thing.
Yeah.
And yeah, they're floating around 7% for investment property. And what that means is, like, if it's not going to be your primary residence, something you're homesteading, you're living in, it's a secondary home, it's an investment property, those rates are a little bit higher.
Yes.
So yeah, he was thinking about, okay, if I buy now, an option maybe in a year is to refinance at a lower rate, or you're saying the option is you can buy at the closing table,
right,
a lower rate. So what does that mean for people? Again, we work with a lot of first-time home buyers. Is that something that's available for first-time home buyers or just for investors? And what do those kind of, I know a lot of variables go into that, credit score, income, things like that.
Right.
But buying points down, what is the cost in that? And is that more feasible on average than waiting for that interest rate to drop? Maybe in a year refinancing, you know, you're basically balancing closing costs in a year and you're kind of betting that interest rates are going to be where you want them.
Right.
Or is it more cost efficient to buy a few points down now?
Okay, so everybody's...
That was a loaded question.
Yeah, yeah. So no, everybody's different, right? But the good thing is, we take the time to sit and analyze. What is your long-term goal? Like, do we want to pay that money now? Is it more efficient to do that? Do we want to just kind of lock in now? Let's get going. Is this going to be your forever home? Are you going to sell it in a year or two? So does it make sense? Where's the break-even point? So
okay.
we take the time to sit and talk with our clients and figure out what's best long-term for them, right? Mm-hmm. I would love the refinance business again next year, but I don't sell loans. I work with my clients. I'm more like a financial mortgage advisor, right?
Yeah.
So we take a look at the big picture. So, but it was very surprising with our client. He's like, what? He goes, I don't want to refinance next year. He's like, then I have to pay all those closing costs all over. He goes, I'll just pay the points now. So the options with interest rates is basically, we always try to quote you at what we call par pricing. Mm-hmm. Meaning if you want a 6% interest rate, you get it, you don't have to pay for the rate. Okay, so you can get above par pricing if you want to pay for the rate. Wait, let me turn that around. If you want to, if you want to pay for the rate, you can get a lower rate.
Yeah.
Right? So you can pay for that and buy that down, and we always do a break-even point. Like if I pay $2,000, am I going to save $10 a month? So $2,000 divided by $10 a month, how long is that going to take me to make up for buying down that rate, mm-hmm. right? Or you can do above par pricing, and you could actually technically get a closing cost credit. So if you actually need some funds for closing, you could take a higher interest rate and get a closing cost credit. Nobody wants a higher interest rate, but if it helps you with the closing costs, mm-hmm. that's like one of our options to help our clients that need funds for closing.
Yeah, so I like the way you look at it too, because it's kind of, you hear on podcasts and news and stuff, people talk about like health things like this, and it always feels like a one size fit all. And I love when they have experts come in and they're talking about health. They're like, well, everyone's different. Everyone's metabolism is different. Everyone's work-life balance is different. Mm-hmm. So if you're talking to a nutritionist or a fitness coach or a doctor, like they're going to look at your numbers. So I love the fact that you take the time to literally diagnose where they're at today. Yeah. And then we can make more informed decisions about what's the best play today based off the information we have. That's great, because then you're setting people up for success today, because some people aren't, time is a thing. Mm-hmm. So it's like they want to get into a zip code, they're starting a new job, they're doing this, that, or the other. And that's the other thing that people are concerned about if they're buying homes. Maybe they need more cash on the side to do some renovations in the property. So mm-hmm. yeah, we'll take the credit on closing costs and go up maybe a quarter of a point or something. We'll go a little bit above average, and then that'll help them with their cash on hand, right. Especially if we're thinking a recession's coming in the future. So maybe they want that cash on hand, and then when interest rates drop, that might set them up better to do the refi in a year or so with you. Mm-hmm. So yeah, there's different ways to skin the cat, so to speak. But it depends on the person's situation. So
yeah,
I like that.
Yeah, everybody's different. So the point is, like, do you want the house or do you want the interest rate, right? So I don't know if you've heard everybody saying out there now, they're like, marry the house and date the rate, right? So it's like, just if you want the house, just let's get in and let's do what we can, and then if we need to work with the rate later on, we can. Or yeah. So yeah.
And really, too, the other thing is it comes down to the monthly. I always say the monthly bill, and it's like, figure out what that number is feasible for your family or your situation, and let's think of all the different ways we can make it fit into that to where it's affordable. You're not breaking your budget, and you're getting in the property, because at least from my side of things, Central Florida, we're not seeing people losing property value over the long period of time. And even as we go into the future, the demand is so high that even if that demand continues to go down, it's actually probably healthier for the market for us to see that a little bit, because we're not seeing such a hockey stick and it's pushing buyers out of the market. So it's actually better for buyers right now in terms of pricing, in terms of an investment, because yes, you may be buying at a higher rate, but you're still getting equity add over the next 5 to 10 years.
Absolutely.
So there's a lot of different variables to think about. And that's why my number one thing when people ask me these questions is, I'm going to send you Barbara's number because you are such an educator on this stuff. And I know you're keeping such a good pulse on all of it. Anything else that you feel like you're hearing from buyers, or things that you want buyers to know about if they're going into it right now, or they're sitting on the fence? You get a lot of people that are renting, and rental prices are going up. And that's something that I predict is going to continue to rise because as investors are buying these properties, the demand is still here, but maybe people are afraid of buying right now. Like you said, marrying the home and dating the rate. They're just choosing to sign that lease for another year.
Yeah.
And we may end up like what's happened, hindsight, 2020. Can't even say that anymore.
Yeah, let's talk about 2020.
2020 is so triggering. Yeah, it's triggering. But yeah, it's like, if you look back, so many people that are, well, I'm just going to rent now and I'll buy. And those are the same people. And I just send them that meme from a year ago, you know, explaining what's going on. So I like that. I'm going to steal that. You know, I'm a colloquialism guy. So marry the house, date the rate.
Yeah.
I like that. But for those out there that are thinking, okay, we've got a lease coming up. Do I sign again and go another year? I can tell you that those rental costs are going to continue to go up because demand's not going down enough. And there's more and more investors buying those properties to become, rental properties. So as that demand stays, you're better off to marry the house and date the rate, I would say.
Yeah, for sure. Unfortunately, I'm getting a lot of phone calls from buyers or, first-time home buyers that are
those are the people I care about. Honestly, those are like I care about all my clients, but those are the people that like I empathize with.
Yeah. Well, they're calling me, telling me about their rent, how much it's going up. My rent's going up $300, $500. We've just decided, that now's the time to buy. But then the other conversation is, but now the rates are too high and the sales prices are too high, right? So it's like, well, how do you find that happy medium for them? How do you get them in that right price point that works for them? It's tough. I really feel for them, but we can definitely sit down. We have some programs where we can show them, if you were to buy a house today and pay this amount in like a mortgage, and you stayed renting, how much, the difference would cost. It's a nice little chart that we can print out and show them. So if you want those, we can do one.
Okay.
But if you just think about it, like my son, he's paying, $1,500 a month in rent. And I keep thinking, oh my gosh, $1,500 a month times 12 is a nice down payment on his next house, but what can he really afford right now? What type of home and, what's his monthly payment? His monthly payment would probably be close to that, so it's tough. It's hard, but our renters, I for sure would love to at least just sit down with them and talk with them and just see, so they know how much money they need to put down and then what their monthly payment would be, and just show them, just so they have an idea. So it may not work now, but if it does make sense now, let's do it. Let's get them in a house now. That way, when they are making those payments, it's going towards their equity and, their investment instead of
and the other thing is, people are like, well, what if this recession happens, I lose my job? Well, then you still have an asset. You still have a home. You can rent it out, or you could sell it, and you're going to get that money back. Whereas if you're continuing to pay those higher and higher rental prices, you're just paying somebody else's mortgage off or investment off. Interesting. Yeah, it's been such a weird time, and we get so many of those questions. But first-time home buyers, we talked about conventional loans. What's going on with like FHA, VA loans? That's another one that we've done a few of them. And last year, all I heard from other agents, especially listing agents, was like, you'll see on the MLS, like a listing, they're only accepting cash or conventional. I love, especially for our veterans, because they've earned that benefit. Like, I was so happy that I think we had like 3 closings in the first quarter last year that were all VA. And I believe every one of them moved in with equity, which in 2021 was like, how did you even get a VA loan accepted? And how did you get those, if they moved in with that? That's something I really wear as like a badge of honor as an agent for my clients. But what's going on in the world of VA or FHA? How are those Fed rates affecting those products for people?
So the FHA loans right now, unfortunately, it doesn't seem to make sense because the FHA loans.
Well, and explain FHA loans. So like, again, first time home buyers, they may not know what qualifies you for an FHA versus a conventional.
Okay. Okay. So on conventional, there's two different types of products, let's say. So somebody who's coming in with 20% down, great, you can walk into a conventional loan, right? The differences are going to be your debt to income ratios, your credit scores, how much money you have to put down.
So debt to income ratio, credit score, and down payment.
Right.
Okay.
Right.
Remember those three.
So, okay, so now a first-time home buyer coming to me, right? I'm going to look at, should we put them in a conventional loan or an FHA loan, right? Now, FHA, the minimum down is at 3.5%. Conventional first-time home buyer can possibly do 3% down. So it's a little bit less. Interest rates probably be about the same. With FHA right now, though, with interest rates, you're more than likely going to have to pay for the interest rate, which doesn't necessarily make sense because you would think, FHA, you want to help first-time home buyers not have to have these expenses.
Right.
But that's what the market is doing right now. They're charging a little bit more for the FHA loans. So they're, just kind of hedging against, what could happen. So they want to charge for that rate.
Okay.
Now on a conventional, they can do the 3% down. Their debt to income ratio, which we can talk about, is only 50%, whereas FHA, they can go up to 57%. Okay. So if somebody has a little bit tighter with their debt to income ratios, then we're going to lean more towards FHA.
Okay.
FHA also allows for a lower credit score.
Okay.
So a 580 on an FHA loan or a 660 is what we like to see on conventional.
Okay.
So again, everybody's different, right? So when they come to me, I can't just say, okay, let's go conventional or FHA. It's all going to depend on what their scores are and their debt to income ratio. It's also going to depend on if there's two borrowers. So who's got the better score? What's the overall debt to income ratio? So debt to income ratio, so we'll just talk about that. So that's like your how much money you make versus your your liabilities that you have. So but it doesn't include electric and so it's just whatever pulls up on your credit report. Okay, so those.
And do student loans pull up in that?
I'm glad you asked that question. So student loans right now, a lot of them are deferred.
And again, I love how prepared you are and everything, but this is so important. Because these are the people like my age group and a little bit younger. These are the first-time home buyers. They do have the student loan debt. They usually have a car payment. They just don't know this stuff. So again, I'm so glad you're here to break this down for us.
Yeah.
And if you're only hearing this and getting a little bit of it to people listening, call me and I'll get you in contact with Barbara and she can go through this with you. And we are here first and foremost to help you figure out and diagnose your situation today. Yeah. And that's what I love about you. I tell every one of my clients, talk to Barbara. The conversation is going to be free. It's going to be a free education that's curtailed towards your situation. Yeah. And again, the thing I love about you, you're not trying to sell them. You're trying to educate them. Right. Because you and I have both had clients where it's let's wait 6 months or let's work on paying these things off or down. So anyway, not to totally interrupt you and derail you, but this is so good. Yeah.
So student loans, okay? So everybody thinks, well, they're deferred right now. So that doesn't count as a payment towards my liabilities, right? Well, it does, because eventually the student loans will come out of deferment.
Yeah.
So we have to know what your, expectations are going to be for what your liabilities will be when they finally come out, right? Okay. So the good news is you have some options with how much we're going to count on a student loan. So we have two different programs. FHA allows us to only count 0.5% of what your outstanding balance is, whereas conventional usually likes 1%, but we do have an option to only collect 0.5% if we can get it approved. So basically, you want to go with using, in your mind, if you're trying to calculate your debt to income ratios, you're going to calculate 0.5% of the outstanding balance is what that monthly minimum payment is. So like on a credit card. You know, like it's your minimum, what your minimum payment is that you're required. So that's the other thing. With credit cards, a lot of people think I have to pay off all of my debt. I have to be debt free before I go into this, which is great, would be a great feeling. But I always tell people, don't spend your money on paying off credit cards. Keep it and save it for a down payment, right? Because let's take a look and see if you have to pay these credit cards off. Because the one thing they don't understand is what we're looking at is the minimum payment, not the overall debt. So if you have $50,000 in credit cards, but your minimum payment is like $200, that's really not a big deal.
They're just looking at that monthly.
We are just looking at monthly.
So everything breaks down to that loan payment.
The
monthly loan payment versus your debt
monthly
payments
debt, yes.
Combined.
Right, right. So don't pay off your credit cards. The other thing with credit is if you have collections on there.
Because that can pull from the down payment.
Right. Yeah, it's gonna. Yeah, you're gonna use funds. Now, if we get to you know the pre-approval process, and we're like, well, your debt to income ratios are just a little bit too high. Let's pay off this card and this card. We're gonna look at the.
We still have plenty for closing costs.
Still have plenty for closing costs, but we're gonna pay off the credit cards that have the highest minimum payment for the least amount of payoff. Right. Okay. So yeah, we definitely.
So it's a balance again of those three things: debt to income ratio, credit score, and what did I say? Down payment, debt to income ratio, and credit score, right? And you're trying to find like the perfect balance with those because we've had clients where their debt to income ratio is skewed a little bit heavy. It's a little bit over 50%, but they have more than enough for a down payment. However, we've also been in that situation where they go off and they pay off a car loan or they pay off something, and sometimes there are penalties on your credit for paying things off too early. So you have to be careful about that too.
Yeah.
So that's why it's so important to talk to a local leading expert about this because you want to find that sweet spot where they all intersect and we can get that mortgage. And again, not to sell you a mortgage, not to put you in something you can't afford, but the goal is to put you in something that you can afford.
Right.
That's at your budget. And that's like, people come to me and they're like, well, I think I can buy between this and this. And it's like, talk to Barbara. Because we got to find that balance. It's, again, I always shoot it back to like health and wellness and stuff like that. It's like, it's not just, are you exercising, eating right? It's like, are you exercising and eating right and sleeping well? Like, all those three things really affect your day to day. And for me, my beverage consumption. But I like that.
Yeah. So with credit, I always tell everybody before you do anything, let's just pull credit and let's see where you're at. And a lot of times, like with credit scores, people are, coming to me, oh, my app says, or my credit card says, this is my credit score.
How accurate are those things? Like Credit Karma?
They'll give you a good ballpark, let's say. But, like if you were to come in, and pull credit with us and then you go into a car dealership, you're going to get two different scores because it's just we score differently. Okay. Right, but we pull from all three bureaus, the main bureaus, so that's where we're getting our scores from. Now, your Equifax score on your Equifax, app may be different than what we truly pull in, but that's why I always tell people don't get too concerned with what your app says. Let's see because it doesn't matter because it's always going to go off of whatever we pull anyway. Okay. So let's pull it in. Let's see where you're at. Now, let's say you come in and you want to get a loan, an FHA loan, and you need a 580. And let's say you're like at a 575, right? We need to fix that, right? We can't give a loan at 580. It has to be 575. Now.
It has to be at 580.
580. Did I say 575?
I do the same thing.
Okay. But here's the trick though, right? You have three credit scores. So the middle score has to be a 580. So you can have a 570, a 580, and a 590, right? But you can't have like a 560, 570, 579, right? So whatever, your middle score has to be, so it doesn't, what I'm trying to say is the highest score doesn't matter. It's the middle score. So you have to at least be in the 580 or above range. So you can have like a 500 and a 600, as long as you have a 580 or above in the middle. Okay. So we definitely need to just pull that in and see where you're at. Now, if you come in, your middle score is like a 575, 579, we can work with that. right?
Okay.
There's probably one little thing that you can do. And so we have our credit agency that we use to pull credit can go in and help us kind of take a look at that and figure out. Maybe it's just paying $20 down on one card, or maybe it's just, just paying down a balance, maybe, $100
Or we've even had like with ours, after our son was born, there was like medical bills that we didn't even know about, like from the hospital, like they didn't mail it to us, or our insurance company didn't cover it or something. That we've talked about that.
Yeah.
And it's like, oh my gosh, I didn't even know that was dragging my credit. But that's why it's so important. And sometimes those don't show up unless you pull a real credit report and you're not just doing like a Credit Karma or something like that.
Yeah, well, the good news about that, that just changed July 1st.
Huh.
So the medical collections, they've always been on there, but we haven't counted them against you.
Oh.
So medical collections don't count. So if you think, oh my gosh, I have to get these paid off, again, before you do anything, let's talk about it before you pay stuff off.
Okay.
July 1st, let's see, it's no longer going to be reported. It also won't appear until after a year. So if you have, a payment due today, they won't report it. It used to be 6 months. Now they won't report it for a year. So you have like a little bit more time to like talk with your insurance company and get it figured out.
Okay.
And then the other thing is, if it's under $500, it won't be reported either.
Okay.
So that's going to help consumers with their credit scores. So along those lines, so if you have a collection on your credit report, the best thing to do is to not pay it off, which sounds funny, right?
Yeah.
But you don't want to pay it off, because now that brings a negative to the forefront of your credit, and then could possibly bring your score down, right? Now, if you're going to pay a collection off, what we're going to do is we want you to call and do what they call pay for deletion. So say you owe $250 on something and it's a collection. If you're going to call your creditor, and again, I'm not a credit counselor, but
Right.
from what I'm hearing from my credit advisors, say you have $250 outstanding balance. When you call them, you're going to ask them, if I pay you this $250, delete it from my credit report. So it's called pay for deletion.
Okay.
So that's what we're going to advise, so that it completely comes off your credit report.
It's like it was
And that'll
separate.
help bring your score up. So you don't want to just pay it off. You want to pay for deletion, because paying
wanna
it
ma-
off
and
is
you
actually
wanna
going to bring
make
your
sure-
score down.
And that's what I like, again, about steering people towards an expert, a local expert that actually answers your questions. Like if I give you Barbara's number, Barbara's going to answer the phone. Like people who, and here's where I'm going to turn it a little bit, and I don't mean to talk bad about big banks or anything like that. I do have accounts with big banks, but I would never borrow money from them.
Yeah.
Just because when I work with clients, especially on mortgages, this is the biggest purchase of your life. And it's so nice to be able, when you call your lender, you're not getting a different cubicle on the phone every time that's giving you different answers every time. It's so nice to be able to work with you and not only get your wealth of knowledge, but your availability. And you guys work with, credit experts that you can send them to. Right. So you guys work in tandem with these other people to really solve the whole problem for their specific need. Right. Which is what I love about working with local lenders. It's my favorite thing to do, because the availability and the expertise, everything that we're talking about now, anybody listening to this can have this conversation with you over coffee.
Absolutely.
Right?
Oh,
and
yeah,
it's
for sure.
specifically curtailed to them, their student loans, this medical bill, blah, blah, blah.
Yeah.
And then at the end of the conversation, you may have to go do some numbers and work with people. But at the end of the day, how that helps you in the buying process is you're educated, you're informed, you really know where you're at, and you really know how much we can go shopping for, which is it sounds so silly, but so many people want to go shopping and look at a bunch of houses, and then they're like, here's one. And especially in a market that maybe we're not seeing 24 offers in 24 hours, but we're seeing multiple offers within a week. We're seeing multiple offers before an open house or after an open house. And you want to make sure, and that's what I love, if I know my clients have a pre-approval from Movement with Barb's signature on there, we're good.
Yeah.
We have a plan. We can get the transaction done, as long as they don't buy a boat or something in the middle of it.
Go shopping at Rooms Together.
But again, I want to keep this educational, and I don't mean to keep like spinning it as a commercial for you and your services.
Oh,
but
spin away.
Okay. Yeah, I'm sure movement hates that. But yeah, it is so good. Like even, I mean, our producer is over here smiling because you guys just bought your first house and you guys worked with me and Barbara and myself. And like, I just see you keep nodding your head over here. Like, it's so nice to know your numbers, right? It's so nice to have a plan, and it makes it easier, and it, because at least you know.
Yeah.
You know what I mean? And you're not guessing. And the hardest thing too, when you're going shopping, like two married guys like us, when we're going shopping, you don't want to look at a house that's $100,000 over your budget. She falls in love with it, you fall in love with it, and then you do things.
And then you talk to the lender, and the lender says no.
You do things backwards, and you're like, oh, now we need to talk to a lender.
Yeah.
Now that we're in love with this house and we could see raising family here and all this jazz, and it's like, oh, that's doesn't work in our budget. Or again, sometimes people are very surprised after talking with you, like, oh, we didn't think we could afford that.
Yeah, true.
Which is nice. You only know what you know. And I just want to break down the barrier. So again, I appreciate so much you like taking the time to sit down and talk through some of this stuff with me, because I want to tear the veil away, the intimidation factor away. So when it comes to financial stuff, there's this just all kind of, it just has this weird barrier to entry, people feel like, especially first time home buyers. And it's just like, you don't have to be afraid, man. So if you're listening to this, you have more questions, hit us up, man, because we can literally do this without the camera and you on the other side of the table, and we can figure out your situation together and go shopping and figure out what works for you guys. Anything we're missing? I know we could talk for 3 hours about this, but so we talked about FHA, conventional, down payment. Conventional first-time home buyers can still do as low as 3%, right?
Yes.
What do you have like a standard recommendation? I know the old school recommendation was always 20%. If you pay under 20%, you are going to pay PMI. What is PMI sitting at right now? Because that's another question that I get a lot. People are like, well, I don't have 20% to put down.
Right. And
I don't want to pay PMI. And I'm like, well, hold on a second, because I think sometimes people are surprised at how much PMI is not what it used to be. PMI, private mortgage insurance, has actually become, as that 20% thing has gone down, it's created a new market in private mortgage insurance. And whenever that happens, it's like cell phones. They used to be super expensive. And now private mortgage insurance, a lot of times, a lot of my clients are paying like $100 to $200 a month on their PMI, which, okay, I'll pay that until I hit 20% on my ratio.
Right.
If that means I can put 5% down instead of having to save that 20% down. But what's PMI looking like these days? Is that a fair assessment?
Yeah, no, that's exactly right. So with my first time home buyers, if I can put them in a conventional loan versus FHA, I will. Only because of the PMI factor, and also they can put down 5% or 0.5% less, right? So 3% versus FHA is 3.5%. Okay. Now, if you go in the FHA route, you'll have PMI for the life of the loan. So that doesn't drop off when you get to 20%.
Okay.
Conventional, sounds like my son's car. Conventional, if they put the 3% down, once they get to 20% equity in their property, and there's a little bit more that goes to that, but just kind of generally speaking, they can get rid of the PMI and not have to refinance. But if you're in an FHA loan and you get to that 20% equity, the only way to get rid of the PMI is to do a refinance.
To do a refi.
Correct.
Okay.
So conventional is preferred, right? So your debt to income ratio is 50%, credit score is 660, first time home buyer 3% down.
Okay.
FHA though, if your debt to income is 57, closer to 57%, your credit score is closer to 580, we have to go FHA. And then we talk about refinancing later on if depending on where rates go in a couple of years or if it makes sense to do it. So,
okay.
Yeah.
Last thing, because I don't want to forget about them. I know I touched on it earlier, VA loans. Give me your spiel on VA loans. If a veteran comes to you, what are those big three in a VA loan product? We're talking about down payment, credit score, and debt to income ratio. How do those three variables play into that VA loan?
Okay. So for the VA loans, they're a little bit different. I will tell you that I did $1 million VA loan. So there's
Jumbo VA.
Yeah. So
Wow.
there's not necessarily a cap on VA. So that's the other thing. There's caps on conventional and FHA, which we got to go back to that. Just I'll throw that in. So on the VA loans, the credit scores are going to be about the same as an FHA. We can go down a little bit lower than conventional. Rates will kind of still be about the same. The one thing with the VA loans is that they are 100% financed, but not 100% paid for, right? So if the house costs $200,000, the loan is $200,000, but then there's closing costs on top of that. Okay. So it's not like it's completely free.
You just sign papers and get a house. Yeah.
Right,
You still have
exactly.
closing costs
Yeah.
involved.
So when you hear 100%, it doesn't mean, oh, okay, I can just walk into this, you know. But with the VA loans, though, I mean, doing that $1 million VA loan, you know, for a veteran that was able to, you know, purchase that. And so it depends sometimes a little bit on, you know, where you are in Florida. There could be some limits on that. But yeah, no, that was like super nice to do it, you know, and I don't understand why sometimes, you know, realtors aren't wanting to have VA
well, I can
offers
answer that.
when these are veterans that have fought for our country. Don't, you know, you kind of.
And here's what I will say, like the VA loans I've gotten done and we've gotten across the finish line, I will say, and this is something you don't hear a lot coming from a real estate agent in the state of Florida. I want to acknowledge that a lot of real estate agents in the state of Florida and a lot of sellers, when they hear that we can do a conventional, we can qualify for that. However, he or she is a veteran, and we prefer to do that. People are usually very receptive to that and want to try to make that happen for a veteran. So that's something that, to all my real estate agents out there or potential clients, if you are a veteran and you're a little unsure about that, you've been hearing that like people are a little skittish with VA loans, don't be. Give us a call. We will find a way. And I have had success for our veteran clients with that, because people do want to honor that. So that's something I'm really proud to say, and I want to acknowledge like a lot of other real estate agents and sellers love it when we get to a closing table and they're able to get the deal done, everybody's happy, and then there's a little extra like pride in we were able to do something for a veteran or a veteran family. It is a cool thing. Jumbo loans. Last thing on VA though, the reason I think some agents or sellers do have some apprehensions with it, in Florida we do get a lot of rain, we get a lot of older homes, things like that, because it is 100% loan. There are more contingencies around that in terms of the property when we're doing inspections and things like that. But again, those shouldn't be things that scare you, because a lot of times those things can be negotiated and figured out during the transaction. So I'm seeing less and less of people being scared of those kind of things, which is good, because we're people are actively looking to create solves around those to get through those WDO inspections and make sure the wind mits and everything are
WDO inspection?
wood destroying organisms, which
Termites.
is termites. But it can also be like if you live in the state of Florida and you have a back door that has a little bit of wood rot. It's very common in Florida because it rains a lot, especially this time of year. And the humidity, you'll get a little bit of wood rot. If there's wood rot, that's a wood destroying organism. It's going to pop on a VA inspection. However, a lot of times those things that pop, those are hundreds of dollars to fix, not thousands or tens of thousands. So it's not something that people should be scared of, and it's something that I'm certainly not scared of. Veterans, don't be afraid about asking about VA loan options for you. You have earned them, and we will do everything we can to fight for you. in that regard.
Absolutely.
Jumbo loans. So you were talking about like FHA caps, conventional caps. At what point do you usually shift into a jumbo loan, and what does that mean in terms of rates, down payments? How does that shift? What does that change?
Okay, so FHA, the max loan amount is $420,680. So if you're in that bracket of, you know, your debt to income and your credit scores, that's where you're going to be capped as far as your loan limit. You could go above that if you have the money to pay for that, but maybe you only qualify for an FHA loan. So it's doable. So you can get a loan for, or you can buy a house for $500,000, but you're only going to get the $420,680 on the FHA. Okay. Now in conventional, $647,200 is the max conventional loan. So anything, if you need a loan for anything more than that, that's where you're going into jumbo territory. So you could be buying $1 million house, putting 20% down,
and it's still a jumbo loan.
It would be a jumbo loan, right? But you could still buy $1 million house and only get $647,200 and just get a regular conventional loan and put the rest down, right? So that it's not necessarily the purchase price; it's the loan amount.
Okay. But on those jumbo loans, are rates going up?
Yeah, rates are a little bit higher. So that's the thing. If I can squeak you into a conventional loan, if you have enough money to kind of just get you right down back into a conventional, I'd rather do that than have you go into a jumbo. There's a little bit more, qualifications that we need to consider. You need a little more reserves on hand, just a few more details that you need to qualify for it. The down payment, we have a couple different programs. So sometimes you can get into them with no mortgage insurance. Maybe 3% down, 5% down.
Wow.
Just depends on what's going on in the market, what programs we have available at the time. So,
is it possible with jumbo loans to buy points down, similar to a standard like conventional? Because I know you're saying like try to get to that magic number. Maybe you can put more money down, so you're only lending the max. But is it possible to just like, well, we have to borrow $800,000? Can we buy down a point?
Absolutely.
And maybe that's cheaper than putting more money down.
Right.
You know what I mean?
Yeah. So again, we sit there and we analyze.
Okay.
We're always looking for those break-even points. You know, does it make sense? You know, do we want to spend money on more of a down payment, or do we want to spend money on discount points, you know, to buy the rate down? And so, before we forget, do you mind, can I talk about the down payment options, like closing cost assistance? I don't necessarily want to call it down payment assistance. It's a different category that's specific to cities and counties. But Florida has this really awesome new program that's out. It's called the Florida Hometown Heroes. And the borrowers can, as long as they're a first-time home buyer, meaning they haven't been on title to a property for 3 years. So they could have owned a home in the past.
Okay.
They just have to have been off title for 3 years, and now it starts over. So now you're a first-time home buyer again. Okay. You can get up to 5% of the loan amount, up to $25,000.
Okay.
So that'll help you with your closing costs. Now there's qualifications that come along with that. There's income limitations, but in Orange County, the income limit is about $120,000 in that ballpark. Purchase prices are the same, or the loan amounts are the same, I guess, the 647 and the 420 loan amounts. The list of people that qualify for that is long. It's not just your normal heroes that you would think of, not just, the police, fire, doctors, veterans, that kind of thing.
Is that just for Orange County, or is that
No, it's for the state of Florida.
Okay.
So all of Florida. So as long as you are full-time employed and have a license to do what you do, if you're a veterinarian, if you're a massage therapist, if you're a chiropractor, dentist, X-ray technologist. There's a long list. So if you want that list, I have it. I actually just posted it the other day. So, so you never know. You might qualify, right, for this.
We should just do a scroll.
Yeah. Oh, yeah. I do. Yeah, I do. I'll send it to you guys. So there is a really long list. So you just have to be full-time in that position, using your license for that position, and first-time home buyer. Now, veterans don't have to be first-time home buyers to qualify.
Oh, awesome.
So they could have already owned a home, in the last 3 years.
And again, to reiterate, up to 5%, up to a $25,000 cap. That's awesome.
So I have a borrower right now.
And that's a credit towards closing costs.
Yes.
Okay.
So I have a
which is
borrower right
huge.
now. She's buying maybe a $325,000 house. She's a corrections officer. She's getting $19,000 to help pay for her closing costs. Now, it's not forgivable. So that's the other thing though. So she's getting the $19,000 towards closing costs and bringing maybe, actually she probably won't bring money into closing because I think she put down $5,000 as her deposit, so that credits her towards closing. So basically getting into her new home for like $5,000 out of pocket, which could also be gifted, which I could mention. But the money that you're receiving for the Florida Hometown Heroes is not forgivable. So if you ever refinance your house or sell your home, you owe the money back. There's no payment due on it though. So it's just basically like, here you go, Kurt, here's $19,000 to help you with your closing costs. When you sell your home, pay it back to me. And I don't want any interest on it. So you would just owe the $19,000 back.
If you live in a home, say, or whoever won that $600 million lottery last night, like they're able to pay off their home, can they just pay that back?
They can pay back.
Okay.
Yeah, or you can make payments on it. Like my borrower wants to start making payments on it so that when she goes to sell her home, maybe she owes a little bit less and, her profit will be a little bit higher at the end. So
cool.
Yeah, so it's really super nice. There's another Florida bond program which allows up to $10,000 in closing costs. So if you aren't a hero, you could possibly qualify for that.
So is that like a blanket credit too? So can that go towards buying points down on your interest rate?
Yes.
Very cool.
Yeah.
So if you qualify for this credit in the state of Florida, again, look at us. We're making a nice story arc for the whole episode here.
Yeah.
Interest rates are the thing people are scared about. If you're on that list and you qualify for this, can that go towards buying, say...
Nope, I stop there. I take that back.
Okay.
Sorry, totally forgot this, you guys. So with this program, the rates are set. So if you're going FHA into this program, you have a certain rate. If you're going conventional or VA into this program, the rate is set by the Florida bond program. So I apologize for that, you guys. But the closing costs the rest of the money can go towards all your closing costs, except for paying off debt and appraisal gaps. So you can't use it towards that. But a lot of times the sellers are wanting to help their buyers out, and oh no, we can't do that on the points either. On other loans, not Florida Hometown Hero loans, we are getting closing cost credits from sellers to help buy down interest rates. So I'm hearing that in the market too. So to help others that are not doing that program, sorry, that's a whole nother topic, but so sorry, totally forgot about that. No, they are set. So we have to look at the rates when we're getting ready to lock in the loan. And these loans don't take any longer, whereas we thought like maybe they took like 45 days to close. It's a regular time frame. It's like with the down payment assistance programs, the SHIP programs that we used to have, those took like 45 to 60 days. These are just normal because we're going to fund the entire loan, and then we deal with the down payment funds like behind the scenes after it closes.
Awesome.
Yeah.
Awesome.
Yeah.
So that's huge though still, because if you're going to shop, you're scared because you're seeing these interest rates doing this thing.
Right.
There's a huge opportunity there.
Yeah, and these rates are they're not significantly better than what's in the market, but they're slightly better.
Well, and if you're getting qualified up to $25,000 towards closing costs,
you can't be too picky about your rates, right?
Yeah, especially if you're moving in and you want to buy some furniture, or you need to do some updates or whatever. That's awesome.
Can I touch on one more thing?
Yeah.
Okay, so gift funds. So if you need funds for closing, right? A lot of people are like, I want to buy a house. They have great credit. They make great income. Everything's fantastic, but they have no money. They haven't saved up, right? Which we got to save up our money, right? Money can come from gift funds, which would mean like if, you have that rich uncle that just won the lotto, right?
Yeah.
Maybe he wants to give you, $10,000 towards closing costs. That's definitely a source of funds for closing that is acceptable. So we could use that. If you have a 401k, I've heard a lot of them lately are offering programs where you can borrow without any restrictions, as long as you're using the funds towards a first-time home purchase. So that's kind of an option as well.
So sounds like there's a ton of options for first-time home buyers.
So if you don't have any money, again, call me. Let's talk about it. Let's find these ways. Let's
or maybe
figure
you
it out.
have money, but you
don't have to use it.
These are things that you didn't know you qualified for. It's like It's like the VA thing. If I can make it happen, great. Any of my first-time home buyers, like, that's why I love sending them to you, because you know all of these ways. Like, oh, look, we're just saving you money on closing costs, because that's great. If you can walk away from the closing table and you're not at zilch, that's great. Because again, when you buy a home, you own the home, you're the landlord, you're gonna have to pay for stuff. So having a little bit of reserves is nice.
Yeah.
And it's also great that we live in a state that's trying to continual encouragement to keep the housing market in a healthy state despite what's going on with the Fed. It's great.
Yeah.
Man, I really appreciate your time this morning.
Yeah, thanks for having me.
Yeah, absolutely. Curtis Gunner, KGTV on IGTV and other streaming platforms. If you guys have any questions, hit me up in the DMs or give me a call. Barb Stewart, our local leading lender here in Central Florida. So thanks again. It was awesome.
Awesome. Thank you.
Cool.